Hello everyone, welcome to INR Bonds weekly newsletter Search for Yields. I am Nikhil. In today's topic, we'll be discussing about a quickly wrap up of 2022 and what is there for fixed income investors in 2023. We'll be discussing about which part of the yield curve is looking attractive and with the kind of duration where investors can play around. And before we go to the search for yields topic, I would request you to check out our QuickInvest app by INR Bonds, which is available on both App Store and Play Store. Download the app to access our curated list of bonds, which are the best bonds available in the market. And for financial advisors, check out our partners portal, where you can sign up and access our curated list of bonds and offer these bonds for your clients and also manage your client portfolios all at one screen. Sign up for the partner portals now. So coming back to the search for yields topic, for the quickly wrapping up the 2022 highlights. 2022 highlights, we started with the geopolitical wars, Russia and Ukraine, where it caused the inflation to abnormally go higher and touch multi-decade highs, especially in the Western developed countries. The UK has also seen a double digit of inflation growth for this year, and US has also seen close to 9.8% kind of a inflation level, which is a 40-year high, and the inflation has peaked out. But however, after the math of higher inflation, all the central banks, be it Fed, ECB, or Bank of England, have sharply hiked interest rates. The Fed rates are almost at 4.5% after the latest 50 pips rate hike, and compared to the last years of multi-year lows of 0%. And the ECB also started to hike rates very rapidly after the energy crisis and the after effects of the Russia-Ukraine war, which is affecting the European countries especially. So the ECB rate is at 2%, and which also shows that bank of the ECB is completely focused on controlling the inflation, no matter what, even if it impacts the economic growth. Even from the latest Fed meeting, it's clear that Fed is also not going to stop till the inflation touches 2% level, and it clearly shows that the rates are peaked at the current levels. The rates are not peaked at the current levels. And coming to the Bank of Japan, the latest meeting, the Bank of Japan also has widened their the bandwidth to let the 10-year government bond curve to movement of 50 basis points from 25 bips. And coming to domestic market, the RBI also has hiked interest rates. The latest round of rate hike was 35 basis points. And also, the meeting minutes showed that they are concerned about persistent higher core inflation, about the bandwidth of 6%. This clearly shows the inflation has not really peaked out, and all the central banks are really focused on controlling the inflation by hiking the rates sharply. So the same theme is likely to going to follow into 2023 as well. The interest rates going up, and which will offer the fixed income investors uh, with the higher yields in the near term, given the near term inflation risks are higher. And coming back to if you talk about the yield curve, the 10-year US yield curve is inverted, where the shorter end is offering more than 4%, and the 10-year USD is offering around 3.7%, close to 3.7% level. In India, the yield curve is almost flat uh, on the expectations of the higher inflation, and also the next fiscal markets are expecting the government to borrow more money from the markets, so which will have a which is causing the yield curve is flattened out mostly. And for the investors who are planning to invest in corporate bonds, at the currently the spread between a 10-year a corporate bond or a 3-year corporate bond is very narrow, and the shorter end of the curve is offering much better yields than the longer end, given the short end bonds are factoring the major risk. And it is a highly it is highly suggested for the non-institutional investors to look at corporate bonds of maturing 1 year to 3 years, where currently they're offering around 7.5% to 10%, depending on the issuer and the liquidity. The use INR bonds credit risk score to understand the credit riskiness of the issuer and the liquidity profile of the issuer, where it will help you to understand for each issuer what kind of the riskiness they carry, and also all the access the curated list of bonds which are absolutely perfect for the market of rising interest rates and higher inflation, where all these bonds are offering inflation beating returns, and also they are highly liquid in case if the investor wants to sell in the secondary market. The investors will have a lot of opportunities in the secondary market and as well as in the primary issuances. Most of the corporates are coming out with the MLD issuances, or even the 2 year, 3 year kind of a range issuances with a very inflation beating kind of a yields. So the investors can opt in to subscribe to these IPOs, or even pick up the secondary offers, and curate their whole portfolio as per the market dynamics. Thank you for listening in. Do subscribe to our YouTube channel if you have not done so already.